We're moments away from the closing bell. I'm Alex Steele.
And I'm Joe Weisenthal. Welcome to a special one-hour edition of What You Missed, the Markets in Turmoil.
U.S. stocks providing no refuge from the global equity rout as the S&P 500 heads for its first correction in nearly 4 years.
But the question is, what do you miss? A wild ride, the market's plunging, diving, recovering, and then diving in again in the grips of a selling frenzy. We crunched the data on one of the craziest trading days in years.
A question of fear. Is the sell-off prompted by spooked investors, and will things get better when cooler heads prevail?
And looking ahead, the perils and possibilities post-correction as the once-roaring bull market fades away.
But first, of course, we have to begin with the stock market. You were looking at S&P off by about 4 points after what has to be one of the craziest trading sessions that I've seen in years.
It's unbelievable. I mean, this morning obviously there was the relentless futures selling. You know, it started with China crashing last night, but there was the relentless future selling. Then the bell rung, huge plunge that nobody saw coming, and then an immediate spike up. At one point, it looked like the market was going to get back to positive. It came really close, and then a major tumble in the second half of the day. Absolutely extraordinary day.
And nevertheless, the S&P has now entered correction territory for the first time since 2011, dropping the most since 2011 intraday. A truly ugly day. And you got to talk about volume, Joe. It was a crazy volume day, too. You had 104% more volume trading on the Dow Jones Industrial Average than you do for the last 10 days. Especially incredible on this summer Monday as well.
Right, exactly. It's supposed to be a quiet August, though we were in a meeting the other day and an editor said something that the quiet August is actually a myth. It's always fun in August, but not this fun typically. Fun, maybe not the word, but extraordinary and wild.
Fun if you were short, I guess.
Fun if you think of it as a roller coaster that you're riding.
All right, well, we do want to take a deep dive here into my Bloomberg terminal. Take a look at one of the stocks that got hit, and that is General Electric, coming in down about 21%, had its worst intraday loss since 1987. And we tend to think of the big guys like Apple,
right.
Netflix are the ones that are getting hit, but these sort of behemoths also.
That really is what made this morning so extraordinary. It is one thing if you see these high-flying tech stocks that have had incredible rallies continue to sell off, but GE, when was the last time we even talked about that stock? And it really,
I talk about it a lot.
Oh,
yeah.
But it's not a very interesting stock to watch typically. And so seeing that dropping 20%, that is just some extraordinary action in the markets. All right, I want to look into my terminal, and another area that was just extraordinarily volatile was currencies. And I want to take a look at dollar yen because there was some absolutely wild stuff happening in the currency market this morning. We saw the dollar absolutely plunging against the yen. You know, the dollar is a safe haven currency, but the yen, when you see this kind of panic, people often buy it. But what I really want to look at, so that's just sort of the intraday chart of the yen, but what I really want to look at is this function, I forget even what it's called, but it shows the gap between the high and the low of the currency. And as you can see, if I get my pen out here.
Your email's up. Hold on 1 second.
Oh, it is?
Yeah. Not that we don't want to see what you're talking about, but let's go over here and see if we
awkward.
can maximize your screen here. Is that better?
Does that solve it?
No. All right. Anyway, go ahead.
Well, I guess the entire world can see my email. But if you could see it, then you would see that the gap between the high and the low of the yen today was at its highest in an incredibly long time. Just, again, you don't expect currencies to trade like penny stocks, but that is what it was like in that morning when everything was going haywire.
It was definitely an incredible move. I also want to take a look here at the copper forward curve, because what's leading? Is it commodities leading the currencies, leading Shanghai Composite, or is it the opposite? And here you see a big decline here. Hold on 1 second. You see a decline here in the copper future. So by January, the market is expecting we're going to see $2.24 a pound for copper, and then we'll wind up seeing a rally as you have the supply side stopping to produce. But the issue is there's still more downside left to come. And if that does affect currencies, if it does affect the stocks, what happens? So
the commodities world is just true carnage and pain, even in the context of everything else.
Yes, absolutely. Pretty brutal.
All right, to talk about carnage and pain, joining us now on the phone from Thailand is Mark Faber, publisher of the Gloom, Boom, and Doom report. So, Mark, do you see more gloom and doom ahead?
Well, I mean, everybody thinks the market is crazy. I think the Federal Reserve is crazy that they printed so much money. And if you look at the volatility, it's just because there is this liquidity bubble in the world, and everybody is kind of a hedge fund and a trader. And so when markets move on the one side, they all pile in, and when it moves the opposite side, they all pile out, and you get this volatility. When the Fed and other central banks tried to suppress individual risks, they created a systemic risk. We have a huge systemic risk. The debt level in the world is, of course, much higher than it was in 2000 and 30% higher than in 2007. And what all these super bulls misread, they looked at the statistics about China that the government is publishing, whereas other people, including myself and some of the closer observers of China, they looked at statistics that showed very clearly a very, very sharp deceleration of Chinese growth, with probably no growth at the present time. So Mark, now the markets realize, and so they're selling off.
So, Mark, most everyone that we spoke to today was kind of picking their buy point. They had their shopping list ready, and they were actually getting invested in the market. Tony Dwyer of Canaccord is now fully invested. What would make you want to put money to work?
Much lower valuations. The people that say they will buy, I just wonder whether they still have money or they have to use leverage. Because before the sell-off began a week ago, funds were mostly invested. They had very low cash positions. And individuals, they had sold stocks, but maybe they needed to sell stocks because they had to meet their living standards, so they bought art or other stuff and so forth. The point is simply, we had a bull market, 6 years old. The market is expensive, is not inexpensive, and multinationals, they have a big exposure to China. That's why GE sold off today. GM has sold off more than 20% from the high. And I think the market is very oversold. We had today over 1,200 new lows, 12-month lows on the New York Stock Exchange. Usually this occurs at the end of a bear market. This has occurred at the beginning. This is a signal that something is very wrong.
But Mark, what would wind up making you a little bit more constructive? I mean, I know that you've been a big fan of gold. Gold had rallied last week over $50, but it still hasn't really delivered the kind of returns that some investors might be looking for. So what does one do with that when the safe havens aren't working, when the dollar is down today?
I think the Treasury bonds look reasonably attractive at this point. The dollar is also such a thing. Everybody was short the euro until just a week ago and very bearish about the euro, and people talked about parity and so forth. And suddenly the euro rallies because we have this liquidity bubble, and when everybody is short and something rallies, they have to cover the shorts, and then the market moves and so forth. We're going to have very volatile markets.
All right, Mark Faber in Thailand, thank you. What a wild day in the markets. We've got much more on all the chaos when we come back.
I'm Alex Steele.
And I'm Joe Weisenthal. What do you miss? Welcome back to a special one-hour edition of our broadcast.
Well, looking at the markets right now, the S&P dropped about 4%, entering a correction for the first time since 2011. The Nasdaq also posting its biggest drop since November of 2011. And the VIX, on the other hand, had a huge surge up, popping to about 40. And for more on that market coverage, we're joined by Jared Woodard, senior equity derivatives strategist at BGC Capital. How did you feel today?
Fantastic.
Why? Why do you feel so good?
Well, look, this has been a massive overreaction by investors and managers to relatively tame situation. Fundamentally, I mean, the economic data.
Actually, we lost your mic, so hold on one second. You're going to keep talking. I'm just going to plug that right back on. This is how we roll on this kind of day. Okay.
Everything's going wild today.
Yeah. Jared, yeah, I know. Mics fall off. VIX goes crazy.
These
All right,
things
so you
happen.
were saying that you were excited today. Why is that?
I mean, I think that the market has overreacted in a massive way. I think this presents a fantastic opportunity for people who are willing and able to take advantage of it. These things don't come along all that often. It takes some guts, but I think there's really something to be done here.
So catch the falling knife.
I mean, hold your nose. I mean, there's different ways to do that, and that's kind of where derivatives markets can be valuable, is in these precise situations. Maybe not every single day, but in these kind of environments, using options to get a more carefully crafted risk profile can give you a much more staying power than if you just try to catch the knife.
All right, so let's talk specifically, because you look at the VIX, but you also look at all kinds of derivations of volatility. What are you seeing out there?
Okay, so on the equity volatility side, there's been a number of different indicators this year where we've seen evidence of option buying and hedging that have been hitting record levels and steadily increasing. The cost of options on the S&P, which is measured by the VIX index, is at high levels. The 5-week change is one of the highest levels ever. The VVIX, which is a increasingly popular measure of the cost of VIX options, hit the highest level ever today.
That's like the VIX of the VIX?
Exactly. It measures the vol of vol, how volatile investors expect volatility to be. And that hit the highest level ever. This is all extremely kind of concerning if you're a long-only equity investor who doesn't know what's happening, if you kind of over-leveraged. But the good news is, fundamentally, U.S. households aren't over-leveraged. They're in a fantastic situation. A lot of investors have been well hedged this year. So I don't think that there's that much potential for further downside once you let these hot hands, these momentum traders, high beta traders, kind of take their lumps and move on.
And talking about the VIX, I'm going to take a look at my Bloomberg terminal to look at a longer-term VIX chart. You basically maxed it out from 1990 to current levels. And yeah, okay, we're right around 40, but we're still not at the peaks that we saw back in 2008, 2009. We're still not as high as we saw back in 2011, 2012. What does that tell you?
Well, it tells me that given the economic data that we're faced with in the U.S., to see VIX levels this high, to see a reaction function that is this extreme is very surprising. I mean, when you have the one thing that everyone did miss today was the Chicago Fed National Activity Index came out this morning. Very popular, very broad. It measures like 85 different indicators, covers kind of the whole economy. It turned positive. This is a diffusion index like PMI. It turned positive for July, indicating economic expansion for the first time since November. And it shows that households are really strong. The economy is very strong. So to see a big panic selling is really counterintuitive and surprising.
Also, I wanted to get your take on what happened. We were talking about the currency madness this morning with dollar yen,
right.
dollar euro. How unusual was that?
I mean, we actually saw a similar situation in currency volatility. You had option measures for the yen, for the euro, all spiking. I think that the 1-month implied vol on dollar yen hit a level we haven't seen since 2013. So similar kinds of extremes. Even in Mexico, they had a kind of a special auction today. I know, as you saw, more evidence of people not just buying options on stocks, but reacting in a big way in currencies as well.
So what kind of calms the volatility?
Sorry?
What calms the volatility?
Oh, well, I mean, I think we can take a page from last year. In the big sell-off in October and December, one thing that really stabilized markets was when valuations got to the level that hedge funds and other buy-side firms came in and said, enough is enough, we really start to care here, and we're going to be buyers of this. Dealers have pulled back for regulatory and other reasons. A lot of folks this year haven't been selling vol, but at some point, I think that the buy side will come in and say, this is something that's attractive to us.
So basically, Jared and Mark Faber just agreed on valuations.
Oh, no.
But nothing else.
All right, thank you so much, Jared Woodard, BGC Capital Senior Equity Derivatives Strategist. Thanks so much for coming. Well, coming up, is it the end of a bear market rally? We'll discuss. I'm Alex Steele.
And I'm Joe Weisenthal. What do you miss? Well, we're in a special one-hour edition of The Markets Selling Off. What are we learning about U.S. confidence as markets drop around the world? Financial Insights President Peter Atwater joins us now on set. Peter, before the break, we just flashed this thing that said on Twitter the hashtag Black Monday was trending. Yep. You pay attention to social media. You pay attention to social mood. What does it tell you when suddenly something in the market expands beyond just practitioners and suddenly everyone's tweeting about it, talking about it, including many people who typically don't care about markets?
Yeah, I think that markets are a social network themselves, and Twitter uses words where the markets use money. And what you saw today was, everybody looking for big market reaction, got it, and all of a sudden you had panic this morning, and everybody went to Twitter to share that sense of emotion. And, this is what you expect to see. What was fascinating, though, about today is that by lunchtime, you had people declaring victory. The worst was behind us. It had been rationalized to either 1987 or to a flash crash, and we were back off to the races. I have never seen such impulsive behavior by investors. It was like a bungee cord of sentiment.
So what does that tell you then?
That tells me that there is a manic mood to this market. And, one of the things that I wrote about a couple of weeks ago was this sense of people feeling overwhelmed. Strange thing, some of the best-selling books on Amazon today are coloring books for adults because they're stress reduction. And that's a very different backdrop to what you would expect to see at market tops. Mm-hmm. Market tops should feel calm. They should feel complacent. But this background of manic behavior is really something people need to watch.
Peter, you wrote that this is not the end of the bull market, but the end of the bear market rally. What does that mean?
That means that if you look at the markets from 2000, what we have experienced is a cycle of down, up, and I think we are about to see further down. The analogy that I use a lot, timing-wise, is this is like 1966 to 1975 all over again, only on steroids. It's taken longer. The extremes have been even more dramatic thanks to central bank actions. But it's the same manicness in the markets that we saw during that period of time, and it matches mood.
So what rally then just ended? If we're in a manic phase, what did we just bury?
I think that we just buried 1972. I think that we are just about to experience the Nixon devastation period. But it fits. I mean, you have Hamilton on Broadway like you had Hair. You have, these people coming out of the woodwork politically. Donald Trump all of a sudden flies to the top of the charts. That's very much in keeping with a 1960s, early 70s mood.
All right, so you like to look at magazine covers and article headlines to indicate turns in the market. What are the kind of headlines we should expect to see when the market finally bottoms? What words should we look for?
I look for expressions of hopelessness. At the bottom, everybody believes it's going lower, that there's no way to rescue things. And you should also see, as much with the headlines, is what's happening in the streets. It's very common to see at major market lows the same kind of impulsive overreaction that you see in the markets happening socially. So I would not be at all surprised if we see social rebellion of varying kinds, not just here, but certainly in other countries.
Fascinating.
Really alternating between dark and positive.
Was it Wall Street, the protests?
Oh, Occupy Wall Street.
Occupy Wall Street.
And that was, that aligned with the October low in 2011 perfectly.
All right.
Brilliant. Thank you so much. Such great insight. Financial Insights President Peter Atwater. And coming up, how market volatility could change the Fed's plan to hike those interest rates. Up next. I'm Alex Steele.
And I'm Joe Weisenthal. Welcome back to our special and extended 1 hour What'd You Miss?
So market expectation of a Fed rate hike has fallen. Take a look inside my Bloomberg terminal, and you can see here that currently market expectation looks to be about, in 3 years, 1.5%. That is the green line, markedly lower from just about a few months ago. Economists also now see just 20% chance of an increase from the FOMC next month. Maury Harris is chief economist at UBS Securities, and he joins us now. Maury, has this sell-off changed your view of what the Fed will do?
You know, I think there's been a lot of overreaction here. If the FOMC meeting were held this week, of course they wouldn't do anything. They could not do anything. But when you think about how much things have changed in the past 3 weeks, and we're 3 weeks away from the next FOMC meeting, there's a lot of room for change between now and then. Fundamentally, the economy is in good shape. I happen to think that buyers this week are afraid to step in ahead of the economic numbers. But once you get your consumer confidence tomorrow, your durable goods number on Wednesday out of the way, you're probably going to see investors stepping in because you've got what I think is a market overreaction here in a fundamentally healthy economy.
Maury, does Janet Yellen care about the market when she sees this kind of stuff happening? You know, she looks at the economy. We all know that. Inflation, labor, wages, stuff like that. Does she care about what the stock market did today or in the last few days?
Well, I think when you get the kind of extreme reactions that you've had here, that's a matter of concern. They can believe the market is going a little bit crazy and is overreacted, but it's moved so much that it has to affect the Fed. I don't think this has that much effect on the economy. I think the upcoming economic numbers are probably going to look pretty good, but the Fed today would be concerned.
Maury, what do you make about the dollar? I mean, we've seen a lot of dollar strength. People have talked about how the dollar itself is sort of creating an implicit tightening already. How does that factor into, whether the Fed is ready to go or not?
Well, you got some pretty good guidance on that from the Vice Chairman, Stanley Fischer, who spoke 2 weeks ago and who'll be speaking again this Saturday. And what he said is that the Fed is concerned about international conditions only insofar as they are serious enough to affect domestic economic conditions. But directly, they're not going to respond or hold back just because of what's happening internationally. What's far more important to the Fed is what's happening in this country in terms of jobs, what's happening to the core inflation.
All right, Maury, thank you so much for joining us on a very busy day. Maury Harris, chief economist of UBS Securities. Our 1 hour special, What'd You Miss? We'll be right back.
He's just not hearing.
Okay.
He's not getting mixed money. Yeah, he's saying his path incorrectly.
So wait, we're doing that now?
Are we going? I'm Alex Steele.
And I'm Joe Weisenthal. Welcome back to What'd You Miss?
Well, a very, very busy day, Joe, and I want to take a deep dive into my terminal to take a look at a stock that moved big that you may not expect, and that was GE. I mean, at one point, plunging about 21%, its biggest intraday sell-off since the 80s, not the kind of stock that you would have thought would have moved this much.
Right, that's the really crazy part. Like, you expect to see the tech stocks go crazy, but when you see a company like a staid blue chip like GE lose $50 billion in market cap that fast, that is some extraordinary market action. So I want to look at dollar yen because what we saw this morning was some extraordinary action in the currency markets. We saw the yen, the dollar tumble against the yen. But what was really remarkable is if you look at this green bar on my chart, and that's this function that shows the gap between the high and the low, it was the highest in a long time. We really saw the volatility just blew out to levels we haven't seen in a long time. Here, if you look at the 5-year version of this, it's still the biggest day in a long time. You expect to see this action sometimes in stocks, but it's pretty extraordinary when you're seeing in 2 of the world's biggest currencies.
What's also crazy is what's going on in the commodity market, in particular copper. So take a look into my Bloomberg terminal and look at the forward curve for copper here in the U.S. And you can see here that the market is pricing in another decline by about, well, I'm not going to do the percent, but down to about $2.23 a pound, and then a rebound. So, Joe, if commodities are really the leading indicator for stocks, particularly in China, this forward curve could spell doom.
More doom.
More doom and gloom. All right, well, let's take a closer look at currencies because China's colossal market rout today dragged down emerging market stocks and FX markets with it. So what are the biggest unknowns that are spooking investors? And what's next for the currencies hit by the slide? For more, we have Merck Investments President and CIO Axel Merck joining us from San Francisco, and from London, Acumen Management Director Ken Wexler. Gentlemen, thank you very much. Ken, what did you make of this currency slide that Joe spoke about earlier, that Joe just spoke about?
In essence, I think what we've seen today is the medium-term pain. So essentially positioning for those players or those participants that have been in for a medium-term horizon, the levels, although extreme as they were, where we saw the likes of the dollar and the euro dollar and similar reach, was entirely on the back of where that most pain would be for the slightly shallower pockets. The volatility obviously is understandable, but given the circumstances, not entirely unsurprising.
Ken, obviously one of the stories beyond the dollar action today has been the carnage in emerging market currencies. How much further do you see, how much more can we expect on that front?
Well, look, ultimately it comes down to an unwind of positioning. I mean, it's often spoken about risk on, risk off in markets, and ultimately I think that comes down to how heavily and in which direction a particular cross or pair may be positioned. And in this instance, I think in terms of the EM stuff, we saw the precursor of today. We saw a lot of that last week. So that move in, say, the dollar try that we saw, I think it was last Thursday, into 3 even to take out that barrier, and similar. So a lot of that has already been, to a large degree, in my opinion, probably done. And now the movement comes along to the more central G10 pairs.
Axel, the big question, of course, for many investors is this a 1998 scenario? And if you take a look inside my Bloomberg terminal, you're looking at the MSCI Currency Market Index. If we wound up having another sell-off like in 1999, you would have to see another 52% decline. Axel, what do you think?
Well, I think we, as was just pointed out, we have an unwinding of position. I think the most extreme was, you mentioned the yen earlier. Look at the Kiwi yen cross. I mean, that was just classic unwinding of some very levered positions. And if you can just broaden that to anything that's been happening in the markets, anybody who has had a position on probably had that seen unwound. The euro has been rising relentlessly. Well, guess what? Everybody has been, quote unquote, hating the euro. And now people are reducing positions as volatility comes in, and with that there is a lift towards the euro. So what we see is we're coming off years, really, where central banks have bred complacency. That means people have been piling into positions that are nice and perceived to be low risk, but of course they're risky. And as risk is resurging, it's blowing up in people's faces. So I think the real story is really in the G10 that's been happening over the last week. But yes, in emerging markets, there's carnage. There is suffering of the weaker players. In fact, China, that's been getting a lot of the heat, has been, again, one of the more prudent players with the volatility in renminbi, much less than that in many currencies.
Actually, you mentioned the euro rallying relentlessly against the dollar. Typically in a panic, eventually you see people just want to grab dollars because they're safe and it's the greenback. When does that kick in? When does the panic get so intense that people will just grab dollars regardless of what they think the Fed is going to do?
Well, it's a myth, and the reason it's a myth that in a quote-unquote normal environment that should happen, but what's been happening is that the dollar has been rising in a risk-on environment. The stock market has been rising over the last year, or the last 9 months at least. The dollar was rising together with the S&P 500. So it is not surprising that when the S&P is tanking, that the dollar is not a beneficiary. These correlations are not stable. The places to hide are not always the most obvious ones, and when we have volatile days like today's, it's a very very tough lesson to learn for many, because precisely because of what you say, people thought they were safe shorting the euro, and guess what? It's not safe.
And it just seems like a lot of currencies being taken out to the woodshed. Ken, if you take a look inside my Bloomberg terminal here, I'm looking at the U.S. dollar versus the South African rand, and you see that spike with the U.S. dollar just getting a lot stronger as the rand gets pummeled. But let's be honest. I mean, gold has been holding up really well. Fundamentally, what are the reasons why, say, the South African rand should be getting hurt?
Well, ultimately, I mean, the state of the underlying economy, certainly in South Africa, is less than stellar. And I mean, comments by their central bank this afternoon, for example, saying that they were contemplating or would be prepared to enter the FX market by way of interventions and you know, protecting the weakness or further weakness of the rand, are frankly laughable, given that they're holding somewhere in the vicinity of only 40 billion in reserves. So while today's blowout is obviously extreme on the back of further unwinding and whatnot, I think we will come to a point soon enough where we'll settle and fundamentals will ultimately take a hold again, but that will certainly mean a weaker rand going forward.
Ken, what kind of signpost would you look for to tell you that the trend, that what we're seeing lately would reverse itself?
Well, the signpost would be, obviously, everyone's been clamouring about volatility and the lack thereof, and now they've got it and they don't know what to do with it. Obviously, as things wind down just a little bit, I mean, nothing like today passes completely unmarked, and so it's going to take at least a few more days and maybe just to see how the market reacts to the first signs of, say, even US data, irrespective of whether it's poorer or better than consensus and expectations and what they may or may not mean for the FOMC in September. It's more a function of, are positions actually clear enough off the table now that people are looking at the market rationally, or is there still room to clear stuff off the table?
Axel, what currency are you going to be looking for when you get up tomorrow morning? What's the leading indicator?
Yeah, let me just add to thought to that. I would agree in a normal environment. The reason why I think this time is going to play out differently is because the markets are going to act differently. People are going to look at the glass half empty now, and the stock market is going to take weeks to adjust. And in that context, normally I would think the FX market is going to adjust quickly, not in this case. Now, as far as what I'm going to look at tomorrow morning, of course, just as we had this back and forth in the stock market today, it's quite possible that investors are going to test some of these things. The euro has appreciated dramatically. The yen has strengthened dramatically. There's going to be some back and forth on that. I do think, though, that because I think the volatility is going to persist and possibly even go up in the coming days and weeks, we will see more of what we see right now. And it's going to be the odd places that are going to gain. It's something like the Swedish crown. You wouldn't have thought that it's going to be a main beneficiary, but it is, and I think it's going to continue to do well in the medium term. But, of course, tomorrow I don't know what's going to happen.
All right, well, fascinating stuff. Thank you both. Mark Investments President and CIO AxoMark and Acumen Managing Director Ken Vexler. Thank you both.
Thank you.
We'll be right back, everybody. Stay with us. I'm Alex Steele.
And I'm Joe Weisenthal. What'd you miss?
Well, the S&P 500 has sank into correction territory all day here, I should say, on Bloomberg Television. We have heard from some of the best voices on the global equity sell-off. Take a listen.
I certainly wouldn't be a buyer today.
I think in the short term, it's a panic. This is a short-term, painful correction.
And I think people had a genuine hard time sleeping last night.
A vertical down like this is just, it's not something you want to step in front of.
Usually this occurs at the end of a bear market. This has occurred at the beginning. This is a signal that something is very wrong.
The fundamentals really don't warrant this. These rapid moves in prices are not matched by changes in the underlying intrinsic value of the businesses themselves.
The central banks for the last 7 years have been pumping up asset prices, pumping up commodity prices, pumping up equity values. You keep pushing them up high enough until they get into very thin air, they're bound to correct.
I don't want to say it's a healthy correction.
No correction is healthy. It's a correction nevertheless.
There is such a thing as mean reversion, and these things are healthy. We haven't had a correction since 2012. We were due for one.
But it's not without precedent, since it's the kind of thing the markets go through every once in a while.
Unless you believe the Chinese economy is so bad that it's going to pull the global economy into another recession, then I don't think it's likely we're going to see a 20% correction on the S&P 500.
Given the rate of change of price, again, versus intrinsic value, it's more of a buying opportunity for us than anything else.
The people that say they will buy, I just wonder whether they still have money or they have to use leverage.
You want to be buying into companies and countries with big balance sheet. You need resilience. Second, you need well-managed areas. And third, you need to be in a forward-looking industry, not a backward-looking industry. And I think active investors are going to get very excited once the smoke settles that there's lots of value being created, and there'll be lots more value being created over the next few days.
You just saw our next guest in that montage. This sell-off is no surprise to him. Joining us now is Doug Ramsey, Chief Investment Officer for Leuthold Whedon Capital Management. He says that losses in the S&P 500 could reach 20%. Doug, what is going through the minds of investors after today?
Boy, I don't know. It was a crazy day, but, you know, I think probably given the experiences here the last 5-6 years, they're preparing to buy another dip. That's been rewarded time and again now over the last 5 or 6 years, and I got to believe they're getting ready to do it again. So I wouldn't be surprised if we get a nice bounce where that looks like, again, it's been the smart thing to do. But I would be a seller into any sort of meaningful, 5-7% bounce here. That might be a catalyst for us to get to maximum defensive posture. And we're almost there right now. Not quite. We've got a little bit of powder where we could reduce our equity exposure even further if we get the bounce that might materialize here.
And Doug, you turned all out bearish in August, and you're forecasting perhaps that the fall in the S&P could reach 20%. You measure breadth. So take a look inside my Bloomberg terminal, and this is the number of stocks in the New York Stock Exchange that have hit new 52-week lows, and this is just as of Friday, hitting at about 601. Yeah. What does that tell you?
Well, what we had keyed on prior to the last few days was that, until we had this collapse down the last 3 days, that you had a very large number of stocks making new highs and new lows simultaneously. And that historically has been a bearish condition for the stock market. I mean, it just means there, to use a $10 word, there's a lot of bifurcation under the surface. And in other words, healthcare, biotechs, leading the charge, making new highs until very recently, while the commodity-oriented and the deep cyclical stocks were at new lows. I mean, now we have a situation where things are getting in gear on the downside, but we had enough of a warning in terms of a breadth breakdown that's lasted many months. Some of the key leading groups like the transportation and the utility stocks, and then let's dial all the way back to 14 months ago, we had a peak in high-yield credit. In other words, spreads got to their tightest level on the entire cycle. So we've had some warning signs, that in some cases extend now more than a year. So the idea that we would step in and buy after a mere 10% correction, I think it's premature.
All right, Doug, so you think it's going to go lower, but as it heads lower, are there certain areas of the market that you might be looking at, areas where you expect to find bargains?
Well, I think there will be a couple phases. I mean, the first, I think we'll see a traditional flight into economically defensive areas. I mean, healthcare now has been leadership for over 4 years. But healthcare, at least on a relative basis, we think is probably going to have one more blow-off move, blow-off on a relative basis, where it really outperforms the rest of the market. Also consumer staples and probably utilities. So your classic defensive sectors, I think, will do well in the first half of what's to come. And by the way, I'm not talking about, I don't expect a 31-month bear market like we had 2000 and 2002, or even a 17-month downturn. I think, this whole thing could come to a head in the next couple of months. But I think it's when you start to see a transition into the groups that have been left behind, like the energy, materials, and the deep industrial cyclicals. I mean, that will be a sign that things are getting pretty late, when there's actually a bid that emerges for those deeper commodity-oriented and cyclical stocks.
Hey, Doug, what's going to be the catalyst for that bid then?
Well, I think we tend to think of stock market lows being made on an exhaustion of selling, rather than, this popular notion that it's, the bold, well-heeled value investors that come in and just, step in at the market lows. It will be an exhaustion of selling, and you're getting some values created in those areas right now. But again, I think that will be the last phase of it, where you start to see some of the strength in those names pick up. So we're on alert for that. But again, I think that's, several percentage points down the road from here.
All right, great. Thank you so much, Doug. Thank you for your perspective. Doug Ramsey, Leuthold Whedon Capital Management CIO. And as we go to break, the Dow closed down today 588 points, but it does not make the list for one of the worst 5 days in Dow history. Here they are. We were close. I'm Alex Steele.
And I'm Joe Weisenthal. What'd you miss?
Well, throughout the show, we've been discussing the fundamentals behind the global market sell-off, but what about the technicals? Well, joining us to break everything down is Katie Stockton, Chief Technical Strategist at BTIG. Thank you for joining us on this quite crazy day.
It was really wild. It was the worst day, I heard, since August 18th, 2011. So it's appropriate that we're wearing red today, of course, and really it's just been horrible. It's been 3 massive down days, and the bad news, of course, is that it represents a loss of momentum. Momentum was not great to begin with. The S&P 500 had been range-bound, and we really saw downside momentum pick up in the last couple of days. But the good news is that that selling is a little bit panicked, and panicked selling is more likely to be unsustainable.
How do you measure panic selling? How do you distinguish between a day of selling and a day of panic selling?
I think in the last 3 days it's been pretty obvious. Obviously, the declines have just been massive, and really across the board it's been very top-down. It's not all about the companies these days. It's really just about the market, about China, you name it. So it's the magnitude of the declines, but also the volume that's associated with them and the quality of the close relative to the day's high-low range. So when you see a close like we did last Friday towards the end of the day's range, that's usually more climactic type of selling.
We went out right at the bottom.
We did, and obviously saw downside follow through immediately this morning with the futures down at 100 handles.
So you brought some charts with you, actually, of what you're keying in on. And if you take a look inside my Bloomberg terminal, here is the percentage of stocks that are above their 50-day moving average. Tell us what this chart means to you.
Well, what it reflects is breadth or market participation. So when you see that number contract, it means less stocks are above their 50-day moving averages, and that shows that more and more stocks are losing momentum. And by its nature, you'd think, well, that's not a good thing, and really it has not been a good thing for the market. But there is a point at which these measures of breadth become oversold or overdone on the downside, and I think we're pretty much at that point. It's when you see less than 30% of the S&P 500 below their 50, or above their 50 days, I should say. That's when you get a bit oversold. And we are at that point.
What do you say to people like, say, Tobias Lefkovich at Citi? He's a big critic of breadth measures as a useful guide to the market. He says, it's always narrow. There's always 1 or 2 groups leading it and others laggards. Why do you think that's wrong? Why do you like that?
I don't think that's wrong, actually. I would agree that breadth is not a great indicator for market tops, for identifying tops. So breadth is often out of line with the broader market's direction or the direction of the major indices. But it's when you get these oversold extremes that it really sends a message and does tend to help you identify market lows when they're occurring. So from that perspective,
rally narrowly for a long time.
It can, and it has done that, actually, yes.
So take another look inside my Bloomberg terminal, and I'm going to show you a 5-year chart of the S&P. Where is the next support level, and what does this tell you?
So we have, unfortunately, sliced through a couple of support levels with this decline. But my discipline, I always wait for consecutive weekly closes below important support levels to confirm breakdowns. And what that helps you do, essentially, is miss shakeouts, where these shakeouts can be false breakdowns. So to me, we haven't necessarily seen a confirmed breakdown below various support levels yet. The level that I'm watching this week is about 1940 for the S&P 500 cash index. I would like to see us get back above that level and close there, and that to me would preserve the uptrend that began last October at that October 2014 low.
And what makes 1940 special? Why does that number stand out to you?
It's a retracement of the uptrend that began in October of last year based on these Fibonacci ratios, which are very common technical tools. And that low was around 1820, so it's the retracement versus that low and versus the high in the S&P 500. 500, which is close to about 21.35. So I'd love to see us close back above this Friday, above 1940, to really preserve that up move and to prevent additional downside risk to that 1820 level.
And we are just hours away from Asia opening, and one more dive into my Bloomberg terminal to take a look at the Shanghai Composite. Katie, what are the levels that we need to watch tomorrow when we open, and what are you thinking?
Well, what I'm watching in China is essentially the gapping nature of these markets. So we've already seen a prolonged correction there, and now that we're seeing gaps down, they to me look a bit more exhaustive than breakaway gaps. So you're seeing these gaps down in a mature down move, or what I think is a mature down move. So I think the correction phase is more likely on its last legs there. Would not be buying aggressively by any means in China, but there is still support for these indices, for the Shanghai Composite, for the Hang Seng Index. And you do have oversold conditions, of course, having returned there. And you can argue, at least for the Shanghai Composite, that it's still in a long-term uptrend based on where it has been relative to higher highs, higher lows.
Where would it have to get down to break that long-term uptrend?
I think around 3,000 was the level that I was watching. I can't be sure exactly the support level.
We could get there by Wednesday at the pace we're going.
These things happen quickly these days, but really a fast and furious pullback is better than the alternative. You'd rather see it happen swiftly because that would suggest that it's a counter-trend move as opposed to something much worse.
And we would need another like 40% decline or something to get to the lows of like the 90s. So there you go.
It's good to take it in context for sure.
Katie, thank you so much for joining us, giving us this perspective. Katie Stockton, Chief Technical Strategist at BTIG.
And that's all for What You Missed. Thanks for watching.
We will see you back here tomorrow. Have a good evening, everybody. You deserve it.